Good evening, dear students. We were dealing with capital budgeting techniques of financial management. In the last video clips, we had already gone through non-discounting techniques used under capital budgeting, that is payback period method and average rate of return or annual rate of return or accounting rate of return method. As you all know, these two methods we are not taking into consideration time value of money. In the sense, we are taking the return as such without looking into the time value of money. Today's session I will be dealing with discounting techniques where this time value of money will be taken into consideration. Time value of money will be taken into consideration. So discounting techniques includes discounted payback method, net present value method, internal rate of return method, profitability index, and terminal value method. 5 methods are there under discounting techniques. Let us directly get into the problem and let us see how we will take the time value of money. What is the difference between discounting technique payback method and non-discounting technique payback method? Both the cases payback could be done, but here time value is taken into consideration, and non-discounting technique ordinary payback we are not taking into consideration the time value of money. Let us see this problem, that is discounting technique discounted payback period. How do we calculate? Look into the problem. Geon Mobiles is planning to invest in a project where its initial capital outlay is 7,600 crores. It's going to invest in a project where the estimated capital outlay is 7,600 crores. Now other informations given in the question are its estimated CFAT. What is CFAT? Cash flow after tax for the next 4 years is given in the question. That is year 1 6,000 crores they are estimating the return. Maybe year 1 end. Assume that this is year 1 beginning they are investing 7,600 crore. Year end they are getting estimated return of 6,000 crore. It's budgeting process. So it's all estimated figures which is given in the question. Year 2 2,000 crores of return they are estimating at the year end 2. Year 3 1,000 crores estimated return is given in the question. Year 4 5,000 crores estimated return it is given in the question. So initial investment of the project is 7,600 crore and various returns, different stream of cash flows for the next 4 years is given in the question. What are the other informations available? Let us check. Expected rate of return is 12% and standard payback period is 5 years. Those are the other information given. What is expected rate of return? Expected rate of return or average rate of, it is also known as average rate of return, or we could also say it as internal rate of return, means if we invest or if any company invests in a mobile venture, we are taking the telecom sector, that is mobile. What will be the average rate of return a company is getting is known as expected rate of return. By using non-discounting technique, we will call it as average rate of return. On average basis, that particular industrial sector, what will be the return in percentage is the meaning of expected rate of return. Under discounting technique, we will use the same word. Expected rate of return will be denoted as internal rate of return in percentage. So these things are given in the question, and they are asked, is the project feasible under the discounted payback method? Let us see how we will do that problem. So I am using a table here. In the table I had provided 5 columns. So the available information I am posting it here. Here years it is given, years of return, 4 years, 1 2 3 4 I had put it here. Return for the first year, second year, third year and fourth year I had posted here. 6,000 amount is in crores, and the CFAT 6,000, 2,000, 1,000, 5,000 I am posting it here. Now how we will proceed with the problem? See, as I told, under discounted payback period, the time value is taken into consideration. We have to find out at the end of the period what will be the value of rupees 6,000. That is what time value factor or net present value factor we are taking into consideration. So rewinding this time value concept, I am putting in front of you the present value table. This is available in all financial management texts. Here I am using IM Pandey text. In the annexure, various financial tables are given. Table A, table B, table C, table D, various tables are given. Here I am using table C, the present value of rupee 1 table. Hence discounting factor 12% is given. We have to take the discounting factor 12% from the table and find out what is the present value or what is the present value of rupee 1 at the end of period 1. That is 0.893. 0.893 is for the first year, that I am putting it here. Second year it is 0.797 at 12%. Third year it is 0.712 at 12%, and fourth year it is 0.636 at 12%. What this net present value factor indicates? This I taught in the time value of money. It indicates that 1 rupee invested in beginning of the year, when we get a return, same 1 rupee at the end of the year, its present value is 0.893. Why? Because of the time value concept, the money value had come down. Today's money is having higher value than what we receive tomorrow. So today invested 1 rupee, we will get it back at the end of the year 1 rupee. It is not having 1 rupee value. It is having only 0.893 paise. Like that, 1 rupee 1 invested in the beginning of the year, after 2 years we are getting 1 rupee. It is having only the value of 0.797 at the end of the year. That is the meaning of it. So these all figures are net present value factor that we are taking into consideration. So all this inflow we have to convert it into based on the net present value factor, which is given in the question 12%. Based on that we had converted. So you could see column 4, it is column 2 into column 3, that is 6,000 into 0.893, we will get 5358. 2,000 into 0.797, we will get 1594. 1,000 into 0.712, we will get 712. 5,000 into 0.636, we will get 3180. It again, I will make it clear. 6,000 we are getting in the first year end, that will be having only the present value of 5,358 when it comes to the year end. 2,000 inflow, cash inflow we are getting in the second year will be having the present value now rupees 1,595 crores. 1,000 crores we are getting in the third year is having only the value of 712 crores when it comes to the third year, the present value. 5,000 crore we are getting return, which is given in the question. 5,000 crore at the end of fourth year is having the present value of 3,182 crore only by taking into the net present value concept. So we have found out the net present value net present total value of the return here. Now in the fifth column we are going to take the cumulative total. First year there is no cumulative total, so it is same. Second year 5,358 plus 1,594 we'll get cumulative total 6,952. Third year again cumulating the return, we will get 6,952 plus 712, we will get 7,664. Fourth year, last year return 3,180 crores. We are adding it and getting the cumulative total return of 10,844 crores. What it indicates? It indicates that 7,600 crore invested in the project, which is given in the question, will get a return of 10,844 crores at the end of fourth year, after taking into consideration the time value of money, that is net present value factor. So that is the total return. When compared with the investment, we are getting high return. That itself shows that the project is profitable. But let us check in which year we will get back the return. We will get back the return in the third year, because 7,600 crore is getting recouped in the third year, 7,664. So the payback period or discounted payback period is 3. Payback period is 3, means 3 years. Within 3 years, after taking the time value of money, we will get back the return. What is the standard payback period here given in the question? It is 5 years. If discounted payback period is less than or equal to standard payback period, I'm writing it once more, standard payback period, we have to accept that project. So here 3 years is less than standard payback period of 5 years, which means that before the standard payback period of 5 years, we had recovered our investment, means the project is feasible. The answer is that Geon's project is feasible under the discounted payback method. This is all about discounted payback technique. Thank you.